Okay, hello everybody, and welcome to Investing with IBD for August 21st, 2019. I'm your host, Arusha Pierce, and with me today is Vernon Bice, portfolio manager for Lord Abbett, and he is also a chartered market technician. Thanks for being here, Vern.
Thanks for having me, Arusha.
On today's podcast, for the first two segments, Vern and I are going to talk about how to adapt IBD's growth investing concepts to an institutional world. And then for the third segment, we're going to have Justin Nielsen come on. He's the director of market research at IBD, and we're going to talk about current stocks. So let's just briefly get into the current market. The current market right now is under pressure. We have one distribution day on both the NASDAQ and S&P 500, but leading stocks continue to hang in there. Now, let's bring Vern on. Vern, I think the first thing to do is, like we've done for a number of guests in the past, your background. How did you get into investing, and really what got you into the whole IBD world?
Sure. Well, I wouldn't have a career in finance if it wasn't for Investor's Business Daily. I got interested in growth investing through my stepfather, John Coons, in high school, who read IBD religiously. John owned a small produce business in Huntington, West Virginia, which was the area that I was born and raised. And he would often talk about what made a good company and whether or not that would make a good stock. Now, IBD at the time was the only newspaper that talked about growth investing and technical analysis, and I was hooked from the beginning on both. But I didn't get started in investing until I was in college.
Mm-hmm.
So what happened there was I tried out a few stocks. I had some success, but I had a lot of failures. But I ended up learning a lot from my mistakes. And then I started to evolve my process and adapt it. And finally, I became more comfortable with the process. And then in 2011, I was lucky enough to meet Tom O'Halloran, and I joined his team at Lord Abbett. And now I spend 100% of my time doing technical analysis.
Yeah, and as we know, Tom also has been influenced heavily from IBD. So you guys over at Lord Abbett with your team there, you're using those principles and adapting the growth investing process into the institutional world, which is pretty incredible in my view.
Yeah, I'm very fortunate because when Tom and I first met, we spoke the same language. We had the same philosophy. We were both trained through Investors Business Daily. And I joined a group of very seasoned fundamental analysts like Matt DeSico, who covers healthcare, and Steve Wortman, who covers consumer, and Ben Abel, who covers tech. These guys know a ton about the fundamentals. But the process there was already in place that looked for three things, basically. Successful investments require three things. One, they have to be innovators. The companies have to be innovators in destroying old industries or creating new ones.
Mm-hmm.
Two, they have to have positive operating momentum. And then finally, they have to have positive price momentum. And when you combine those three elements, that's where you can get some really big winners in your portfolio. So that's what our team does.
And one thing that's really interesting, because with retail investors, you can get more concentrated, you can leave the market, go to cash completely, but you guys don't have that luxury as an institution, so you're forced to adjust. How do you guys adapt to that?
Well, we kind of have put stocks into one of four categories: secular, stable, defensive, cyclical. And like you said, we can't go to very high cash levels. In fact, I think the max we usually go is 5%, usually 3%. But when we do see the market turning against our style, we do have places to hide in the form of more stable growers or GARPy names or defensive areas of the market. So that is a way for us to kind of take down some of the risk and manage some of the volatility of the high flyers and the high growth names.
And one thing that you guys are very, very good at is following a trend, right? You're letting some of these winners ride for a while.
Yeah, that's right. I mean, we use technical analysis because great growth companies aren't always great stocks. And so we've developed a system where we use both absolute and relative price momentum. And the absolute momentum is kind of at the core of our process. And we've put every stock in the investable universe into one of four categories, either an uptrend, a pullback, a downtrend, or a snapback. And we've defined those categories according to their price data and the moving average.
Mm-hmm.
And so that allows us to quickly look through the investable universe and our holdings for potential changes in trend. Because we embrace uptrends because we like stocks that are going up, right?
Yep.
And we avoid downtrends because we don't like those. But the tricky part is, how do you find when a trend is potentially changing? And that's where we have defined these two inflection categories, one called pullbacks and the other called snapbacks. And a pullback is a potential early warning sign that an uptrend is coming to an end, and a snapback is a sign that maybe a downtrend is ending. So those two categories are very helpful for us to see when a trend is potentially transitioning.
And so for a pullback where it starts to go into that category, where now you're at that inflection point. Now, how long does it usually take, or on average, where it could go now into a downtrend? How long do you guys wait for that?
Well, it depends on whether or not the pullback is severe enough to cause the 150-day moving average to start sloping down.
Mm-hmm.
So the only difference between a pullback and a downtrend is the slope. So if the 150-day moving average is sloping up and the price is below that, we call that a pullback. And then when that moving average turns negative and slopes down after several months, few months, we call that a downtrend. So it does build in some flexibility. And that's where it gets interesting with our team because we have the discussions around those inflection categories. So if there's a fundamental reason to hold on to the stock, we may even hold it through the pullback and give it a little bit of more time and see if it can get back into the uptrend category. But we normally trim just for risk management purposes when a stock does go into a pullback.
Okay, but what about when it goes to a downtrend? Are you guys generally out of it at that point, or can the fundamentals overrule at that time to at least hold a reduced position?
In general, we're usually out by the time it gets to a downtrend.
Okay.
We love to cut our losers quickly and let our winners ride, like you mentioned. So we don't want to hold on for those pullbacks for very long because they do turn into downtrends, and they can be disastrous if they gap down on another quarter or news. So in general, we don't own them, but at some point, we do have small percentages in each name, and in aggregate we try to keep it limited as to the percentage of our fund.
Okay. Now, one thing that, especially, and this is me included, sometimes for listeners out there, we have, it's very easy to take your profits quickly, right? But you guys are great at really allowing these stocks to follow their primary trend. To really just go up for a while and then wait until they truly break before starting to scale out and get out. Any advice out there for those? Because you're from the institutional side, you're looking at it from a different viewpoint as opposed to a retail. Any kind of words of advice on how, for those like me who sometimes sell a little too quickly?
Sure. I think that's another benefit of having these categories, these four categories. As long as the price is above an upward sloping 150-day moving average, you should hold it as long as it's doing relatively well. And there's two components to momentum investing: absolute and relative. So you do have to check on the relative momentum just to make sure it's beating all the other stocks in index. But in general, when you have an uptrend, you should just let that uptrend ride. And by having those categories, it'll quickly tell you when you do hit a pullback. Now, I think one piece of advice maybe when I first started, I was using the 50-day moving average a lot more. And that was a little too short term for me. And then I switched to the 200-day moving average, and that was a little bit too long term for me. So the 150-day moving average came along through a person named Carter Worth, who is at Cornerstone now. And he, maybe 15 years ago, came into my office and taught me to use the 150. And I observed it for several years and tried it out on my own trading and investments. And I just felt comfortable with it. So I think a lot of times when you're selling winners too soon, you just haven't built a process that maybe fits your risk profile, and you might not fully trust in it, if that makes sense.
No.
So I would just say play around with the moving averages, or try to come up with categories that define when to buy, when to hold, when to sell.
Perfect. Well, sticking to the process is everything in the markets, and you got a good snapshot here with Vern. Let's take a quick break, but when we return, Vern and I are going to talk more about the process. We'll dig a little bit deeper, and we'll also go over the 2 assassins of investing. Stay tuned. Hey everyone, it's Arusha. On Tuesday, August 27th at 11:30 a.m. Pacific time, we are going to be having a free webinar called Finding Breakouts and Avoiding Fakeouts. Now, in this free webinar, you're going to learn the ins and outs of stock breakouts and how you can use them to consistently boost your returns. We'll show you how to identify high potential breakout candidates and when to buy them based on simple, time-tested rules. You'll see IBD's 3-step routine that makes it simple to identify stocks before they go on these big runs. Join Matt Galgani and Amy Smith next Tuesday. And to register, go to investors.com/webinar. Vern Bice is our guest on Investing with IBD. So Vern, let's talk about momentum and the 2 assassins of investing. So the first question is, why does momentum exist in the market?
Well, the academic research out there that I believe in says that momentum exists because of human behavior and the biases that we all possess. The 2 assassins, as you mentioned, in my opinion, are ego and emotions. Mm-hmm. So it's very important to find a system or a way through your process to dampen those 2 evils of the investment world, the ego and the emotions. So greed and fear, along with ego, drive investors to make irrational decisions. And this has been going on for decades. I don't think humans have changed much over the last few thousand years, and I don't see them changing in the future. So as long as those behaviors show up in stock prices, momentum should continue to exist and persist.
Yeah, and what's interesting is now obviously with technology that's enabled us for firms to come up with algos and a lot of program trading. Now, does that affect anything, or in the long run, it's still human nature?
I think it's still human nature. There's always been technological developments in the marketplace. Think about when we first started using computers and how that caused some different changes. So there may be enhanced volatility or more trading. But I still think even if you're doing an algo, some human is creating that algo, right? So the human can also override their algos or their processes. And there's plenty of other investors outside of the algo traders like us that are just, active managers. So there's still a big human element in markets, I believe.
Yeah, and now what about volatility? As we've seen the last few weeks, the markets have been incredibly volatile. How do you balance that out?
I think we stick to the process. I keep going back to that, but with this process that we have, I think we've really found a way to avoid some of those volatile stocks, those swings. If it gets really volatile, maybe we give the pullbacks a little bit more time. We also may not get as aggressive when the markets turn really volatile. Yeah. So I think those are a few ways to dampen volatility.
What about time frames on charts? Do you favor particular time frames over others?
I like the weekly a little bit more, and that's a good point. That the weekly will stretch the time horizon out a little bit more and maybe make the stock look less volatile on a longer term chart. Yeah. But we still use the daily and the monthly as well. But yeah, I think when you look at the weekly, you don't get as spooked by some of the market action.
And types of stocks too. Are you looking at that? Maybe large cap stocks versus small cap, maybe newer IPO type of stocks.
That's true. The more you go down in cap, the more volatile the stock. And the IPOs can also be very volatile because they haven't had a lot of history of reporting. So you have a lot of players taking bets on both sides. And so for an IPO, for instance, there's kind of an IPO range that I've noticed over the years, and it can last from anywhere from 3 months to 2 years, and it goes up and down within this range. So you just have to maybe look at your position sizes on names like that, or stocks that are a little bit more volatile. You can use your position sizing to maybe dampen some of the risk as well.
And sticking with that IPOs, so going from a range from the first couple of years, so it's too volatile at that point. It's not worth trying IPOs at that point. Or is it better to wait after those that first couple of years?
I think it depends on the individual stock, of course,
Right.
but sometimes you get a nice consolidation pattern that's very tight. They're very clearly defined support and resistance levels. And then you get a breakout from those resistance levels, usually on some piece of fundamental news. So you always have to be on the lookout for them, right, to break out of some defined range. And the tighter the consolidation range, the better. So yeah, it could be 2 months, it could be 2 years, but usually when that occurs, we'll see it in our process showing up as a snapback after it's gone sideways, and that'll give us first mover advantage sometimes, so we can get in on the name early, because IPOs are within their first 2 to 10 years, a new company has the potential to have explosive exponential growth,
Right.
and so we want to monitor that.
And so let's get into really trying to figure out your risk profile, and really trying to figure out what type of risk taker you are. How do you approach that kind of from an institutional? Really, you have the benefit of both worlds. When you started out, you were an IBD customer. You're learning the system. You were learning it as a retail investor, and so you got one perspective. And then moving into the institutional world, you took the same concepts and you got a completely different perspective. What did you notice?
Yeah, that was quite interesting. Luckily I came into a team with Tom, who had already set up a process very similar to the one I had already as well. And so I've learned a lot from Tom. And we've also learned a lot from each other. All the team members, we've learned a lot from each other about how to maybe look at that risk profile. So I think over the years we've evolved. We've kept the same principles intact. But when I first started out as a retail investor, I tried every indicator known to man, and I thought there was, everyone I think feels like there's some secret or there's some magic formula that only you can find, right?
Yes, exactly.
But then what happened was I didn't fully appreciate my risk tolerance. I didn't have the risk tolerance for shorter term, and I was too impatient for longer term. So I needed this Goldilocks approach to investing, and I think that matches the 150 day again. So I think just talking it out, getting in the game, you have to get in the game, right? There's no way that you're going to learn what your risk tolerance is until you put the money on the line. I mean, I remember reading, I was so scared to invest the first time I bought a stock, because I felt like I prepared, I read, and I thought, okay, I've got it now. I can do this.
Yeah.
And then I bought a stock and it was $100, and then 2 days later it's at 80, and that's when those two assassins come out to play, ego and emotion.
Yeah.
And they wreak havoc on you. So I think just continuing to gain that experience, get a process that dampens some of that volatility, and dampens those egos and emotions that we have. Just keep at it. Just don't give up on it.
And part of that is also figuring out what concentrations work for you, right? So some people are not cut out to hold a 50% position in their portfolio.
That's right. I mean, I think when I first started, I had no money, right? I I didn't grow up with much as a kid, so I had to scrounge to save, $1,000 doing odd jobs to start investing. I think the first thing I bought was the triple Qs, and I could only afford, I think, one share. So I probably had like $200. I don't even remember how much I started with. But, IBD, and when I was learning from IBD, they were saying to invest 2 to 3 stocks, right? And and when you have little money, you have to do that, I think, until you get to some mass. But if you get up to $10,000 and get lucky and get to $100,000, I found myself thinking I need to increase the number a little bit. I was never really comfortable with the one stock because that brought out my emotions more.
Yep.
And I got scared with the short-term noise. And this was before I had developed a process that I have today. So, and then I went to the institutional side where we have to be diversified. And even though we have to be diversified, we don't own too many stocks. We try to be as concentrated as possible. And I found like 50 stocks to 75 stocks, even down to 30 or 25 stocks. 25 to 75 felt comfortable for me because when the markets would go into a correction and then recover, sometimes you mistime it and So I think 25 to 75 now has that's where I feel comfort with. But it's up to the individual. You have to experiment with that as well.
And one of the interesting things with this is anyone can invest immediately, right? There are low barriers to entry to get into this profession.
Yeah, that's right. I think we joked once. It's not like brain surgery where I can just say, oh, today I think I want to operate on a brain. So with investing, anyone can get in, and there's such a low barrier to that profession, which is great. That's one of the beauties of America is having the stock market where a person can save a little bit of money and put it into the market and maybe change their entire life. What better game? But what happens is I think some people get into the market and they lose and they give up or they're too hard on themselves and they end up blaming the market or saying that it's rigged and they run away. So you have to just stick with it and trust in capitalism, really, and the system that we have. The market has been consistently putting out these great growth companies year after year. And we believe right now is the best time to be a growth investor because the technology revolution is allowing these innovators to disrupt and drive performance like never seen before.
No, that's perfect. And you used the brain surgery analogy earlier. The reality is, even with the brain surgeon, they have to go to school for years and to get that experience. So same thing, and when you're investing in the stock market, which is going to be the hardest thing for most people that they'll ever do, you have to get that experience and kind of work through it, learn from the mistakes, and really understand what type of investor you are and what type of strategy works best for you. So thanks, Vern, for joining us today.
Thank you, Arusha. It's been a pleasure.
Coming up next, we will have Justin Nielsen on the podcast, and Justin and I will talk about current stocks. Stay tuned. Want to find stocks like the ones on this podcast? A lot of the best names we talk about come from IBD's exclusive stock lists, like the IBD 50 and the Big Cap 20. Whatever type of investor you are, we got a list for you. You can access every one of IBD's lists, plus stock ratings, exclusive analysis, and one-on-one coaching with a membership to IBD Digital. It costs less than $1 a day, but for podcast listeners, we're offering an even better price. Go to investors.com/podcast offer right now and get your first 2 months for only $20. Welcome back to Investing with IBD, and we have a cameo appearance from Justin Nielsen, Director of Research at IBD. Thanks, Justin, for only joining us for one segment.
Hey, no problem.
So, Justin, before we get into current stocks, let's talk about the current market and what you're seeing.
Well, the big thing is, and you mentioned this in your earlier segment, that we are under pressure. And that really happened because we had the follow-through day. That put us to confirmed uptrend, and then we undercut that follow-through day immediately. And a lot of times when you undercut the low of the follow-through day, that usually leads to more weakness. And it looked like that's what was going to happen. But now we've kind of steadied ourselves. Of course, you had all
now,
sorts.
let me hold you for 1 second. That undercut of the fall through day, that was also a distribution day too.
It was.
Did that play into account? I mean, that was even worse, right? When you saw the
what we do
undercut.
we have done some studies on when you have distribution days immediately following a follow through day, how the likelihood really increases of that follow through day failing. However, the very minority of cases where they still work, they worked in a big way. So we want to make sure that, and this is the problem sometimes when you have a low sample size.
Yeah.
You can have those kind of distortions. So we're very careful to not say like, oh, don't play anymore, because you don't want to miss one of those big moves because you're like, oh, I got out because there was a single distribution day. But the main point here is that we are still holding above the lows, so that's the rally is still intact. That's why we haven't switched back to market and correction. We're keeping it at under pressure, and really the 50-day moving average, we keep on bumping our head up against there.
Yeah.
And I'd like to see it get back above there and stay there, because even that 8,000 level for the NASDAQ, it's done this over the past year now where it crosses 8,000. It can kind of hang out there for a little bit and then not so much. So it's a matter of can we actually start putting some time above that 8,000 level and get back above the 50-day. So those are the things I think we need to look at. So it's also important that you don't get all in on a follow-through day. That's why you have to put in a little bit at a time. You don't want to go on margin that day, and because then if there's any shakiness that happens, you can get shaken out of your stocks real quick because you don't have any cushion on it.
Right. And really with a fall-through day, when you have that fall-through day, you look for stocks to buy that are breaking out. There weren't too many stocks emerging on the basis on that. So maybe if there's one, you try one and then see what happens. And then it's just kind of slowly moving.
And that way you're letting the market tell you, okay, if you're making progress on your stocks, then you put more money in. If you make progress on those, then you put more money in. And so it's a feedback loop that really works to your favor for a trending market.
Yeah. So now with current stocks, what's interesting is with the markets underneath the 50-day, but there are quite a bit of quite a good amount of current stocks that they're acting like it's still a great market.
Yeah,
it's amazing when you look on a weekly chart. You wouldn't even know that we've had all this volatility.
Right, exactly. And, for as much as people have been talking about like the recession fears and the inverted yield curve and, all of these things, today you had a lot of retail names coming out. So they're like, what recession? And Nordstrom after the close and looked like it was up big in after hours with a beat. So there's a lot of stocks out there that are still gapping up. I mean, we're on the tail end of earnings season now, but you still have a lot of big moves in stocks coming, and more importantly, those setups that once we do kind of right ourselves could be, our new catalyst for a big move. Okay,
perfect. So, Justin, let's get into current stocks now. And the first stock that we're going to talk about is Twitter, and this is a stock that I own shares of, and obviously, well, let's hope that everyone knows what Twitter is these days.
Right, exactly. I hopefully we don't have to get into the fundamental story here. Right. Now, the one thing that people should be aware of, what is it that's going to make Twitter go up from here? Everyone knows the story. It's not like there's something amazingly different, but it's about subscriber growth and engagement and what can they do to get more of that advertising revenue in.
And also what's interesting, and this is something that they talked about in their most recent quarter, they have really focused on reducing malicious behavior on Twitter too, so to make it a more friendly site, which will actually help with the growth and the retention,
right?
Also, right, and the quality of everything would be better too.
Yeah, a lot of the social media platforms, what they're having to do is they're having to build a certain level of trust with that relationship, whether it's over privacy issues, what have you. But a big thing is that bullying and what comes, as a result of it, and there's also the fraud, the fake accounts and things like that people get concerned with. But on the news side, there is a lot more that they're doing with video and some of these events that happen. That's something where they could have opportunities for further growth as they get numbers for some of these events that they're that they're covering and live tweeting about.
Right. And also on the international aspect, 15% increase on daily active users this quarter. So it's starting to catch on more and more internationally. Now, me personally,
Is that so that they can just keep track of Trump and what he's tweeting and stuff?
Yeah, and that's growing. That's definitely growing.
Is he trying to buy Greenland or what something like that?
Or all the memes that come out with the Greenland memes.
So.
Well, now for Twitter, it broke out recently, and now this is one of the stocks that has been hanging in there during this volatility, right? So it broke out, came back in a little bit, didn't come anywhere near being down 5% even from its pivot, and now it's near new highs or 52-week highs.
Right. So this had a 41.02 entry, that it kind of broke out of that cup with handle, and even though it did dip down below that, now considering what the market was doing, that's okay. It's stocks are going to kind of pull back with the market, but it did hold very well and quickly got right back above that 41.02 entry, and so that was one of the reasons why this actually attracted our attention on both Swing Trader and on Leaderboard. So we put it on Swing Trader on the 19th of August, and we started it with a half position early when we saw it moving, and then we followed it up after it started crossing into new high ground. After the first hour, we just want to make sure that this was something that could gain some traction, and it did. And so we followed up there, and Leaderboard actually put it on, I think, the next day as it was again holding there. And so now it's still in its buy zone.
Yes.
That 5% buy range.
Yeah, it's at 5%. It's 5% from the pivot right now.
Right, exactly. And we try and keep it in that buy zone, try and keep our buys in the buy zone like that, because if you get too extended, then you're more ripe for a pullback and getting shaken at.
Exactly. And now their earnings on the quarterly earnings acceleration went from 63% in the December quarter to 131% in the March quarter, and now the June quarter 829% year over year. So things are going pretty
incredible
well.
Growth. And this is just these aren't small numbers. I mean, it's it's one thing when you see that triple digit growth, and we've actually had 5 out of the last 6 quarters triple digit growth here, and it's it was starting at kind of smaller numbers with like 10 cents and stuff like that. But we're starting to get into like this last quarter was $1.58 earnings per share. So that's considerable.
Yep. And so let's go into our next stock here. This is HubSpot, and this is another company that I own shares in, and
I do as well. Okay.
And Justin owns shares too. And now these guys, they've been around for a little while now, and they're helping small, medium businesses with marketing engagement. So a lot of obviously a lot of things transformed over the last 15 years with search engine optimization, right? You have to have your presence on Google, building more engaging content where now you're going to attract people through just kind of articles and stuff like that. And so now they come to your site.
And most importantly, turning those into sales.
Exactly.
So that's the big
which
thing.
they help too.
Right.
Track
Exactly.
sale leads and conversions.
Right. So there's all sorts of when you start learning about some of these companies, there's all sorts of acronyms you have to learn, like CRM, customer relationship management, SEO, search engine optimization. All these different things. It's really a lot about getting better and better data. So that you can figure out how to strategize. And as you said, it's a lot of that free stuff that kind of brings them in, and then now how do we turn them into revenue?
Exactly. Yeah. I mean, you build the trust with the customers. You show that you have value. Eventually, they get used to it, and then now they're willing to take a trial, or something like that.
And on the fundamental side, here's another one where the triple-digit earnings growth is absolutely incredible. So this one has actually had 6 out of 6. For the last 6 quarters of triple-digit growth, and I mean 37 cents earnings per share. It's not like it's just a couple cents here.
And now this is a stock that has been running for a while though too, right? Like a lot of these cloud stocks,
right?
But while a number of them took off over the last few months and went on some really nice runs, it was interesting to me that HubSpot wasn't doing anything, but now they're starting to come around. So maybe they're able to take the mantle. Their relative strength ratings of 94. So. One kind of concern I have is this a lagging stock, versus some of the other stocks? So we'll have to wait and see on that. But they are 4% from the pivot right now. They are giving you a shot, and they're one of they're one of the stocks that have recently broken out
Right.
since that fall through day.
And the way I was viewing this is looking at a weekly chart. I kind of look at the Q4 2018 is kind of resetting the base count there. So an initial base, a first stage base right there.
Right.
And then, we've kind of had a base on base on base. And the thing I like about those is when, the market is kind of doing its thing, it's still holding its ground. And, sometimes the way Bill used to describe this to me is it's like a spring that's getting coiled. And so, when you get the right catalyst, that can really kind of start moving.
And Bill O'Neill, of course, our founder of IBD.
Mm-hmm.
So these are kind of those little subtle things that I like the coil, the relative strength, stocks that they refuse to start downtrends. And then when the market truly starts another uptrend, now they have the power to really, really thrive.
Exactly.
Okay, let's go to our third stock here. And this is a real interesting one.
Yeah.
Carvana, ticker symbol CVNA. And they're not only a used car retailer, they're one of the first pure play online used car retailers.
Exactly. And so that's their new, because a lot of your, CarMax and, a lot of these have established an online presence, but they're like, we are only online. And, they have some very interesting things that they do. Of course, you can't test drive online, but, you can go onto their website and take a look at a car, get a 360-degree view, and they will, right here, there's a chip, so you can really zoom in to see any flaws that the car might have. And they have a very liberal return policy, 7 days. If you don't like it, then you can return it. So they are trying to, again, build that relationship with the customer and trust.
And I think what's even cooler than all of that is that they have taken vending machines to the auto world.
Right, exactly.
And so all of you, after you're done listening to this podcast, go on the website, take a look at it. They call it auto vending machines, where it's kind of like a tower of cars.
Yeah.
And you get a coin, and you go to a little computer, and you select your car, and you put this coin in. It's like a big coin.
Well, I think usually you've actually purchased it at that point.
Okay,
and so then
it's
they
kind of
send
like
you,
a ceremony.
Yeah. So it's almost like it's like a commemorative coin type thing. And I think you can keep the coin.
Yeah, okay.
But it basically.
So you put this coin in, and it comes down. It was crazy. I was just watching a video on it, and it comes down this little tower, kind of like a gumball, and it brings the car to you.
Right.
Through this machine.
Right. So they're actually building one. I think it's Huntington Beach, so very close to where I live, and off the 405. And I can't wait for them to be done, because I just want to see, I just might hang out there to watch it live. But that's another thing. So they only have I think 16 or so of these vending machines, and so what they'll actually do is they'll supplement your airfare, to go, if they don't have coverage in that market to deliver the car to you, they'll supplement your airfare to have you go out and then drive your car back. So you can just go to one of these vending machines, get your car, and then drive back to wherever you are if it's outside of their market. But they are opening a lot of markets up, to be able to expand their customer base, and they're expanding, of course, the cars that they have available as well.
No, and it's working. Everyone's now, including us, we're talking about this auto vending machine. Now with the stock, they broke out a few weeks ago after they had an earnings gap. So they had they had a report that Wall Street loved, had an earnings gap. And eventually, the next day, they broke out of a consolidation, pulled back as the market was getting a little more volatile, and they into new highs today.
Yeah, and here again, they never touched the 7 to 8% sell rule. So it was one of those cases where it really held. And that was a tremendous gain off of that earnings gap.
That was a big gain.
That was, you might not realize it when you see kind of on a weekly chart or whatever, but that was a 25% gain that day. And now, as opposed to the other stocks we were talking about, this one does not have earnings growth at this point. But this is an IPO. It's in the expansion phase, and it does have triple-digit sales growth going back for 18 quarters. I mean, that's just absolutely incredible. So, and here again, it's not small numbers. This did almost $1 billion in revenue last quarter. So this is growing in a big way, and still able to do that triple-digit growth is incredible.
Yeah, perfect. So those are three stocks that have done well so far since the fall through day, and they continue to hang there during this choppy market. Thanks, Justin, for joining us on this segment. And thanks once again to Vernon Bice for starting the podcast off. So that's it for this week on Investing with IBD. On Sunday evening, Chris Gessel, Chief Content Officer of IBD, is going to be on the Disciplined Investor podcast with Andrew Horowitz. Next week, on the Investing with IBD podcast, we are going to have Howard Lindzen on the show. He's a serial entrepreneur, and one of the companies that he founded was StockTwits. So we're definitely looking forward to having him stop by. So that's it for this week. I'm Arusha Pierce, and thanks for listening. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube.
If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.